Hello, Bob Wells here, and welcome back to the Undercurrent Stories podcast, where we dive deep into the hidden depths of our world, one fascinating guest at a time. I first heard about today's guest while listening to his podcast, Book with Legs, which I discovered after one of my own guests appeared on his show. I found and continue to find the show fascinating, as each week they bring in authors and discuss books. What I find particularly interesting is that the knowledge they acquire forms part of an overall learning strategy which contributes to their investment business. So I was keen to find out more about the podcast's host and curious to understand how this reading habit and wisdom acquired influences the company's decisions on their investments in stocks and equities. So joining us today is Cole Smead. Cole is CEO and Portfolio Manager of Smead Capital Management and host of a Book with Legs podcast. And before I welcome Cole, I ought to just say, after 130 episodes, I'm going to do a little caveat. We're going to be talking about investment, and so anything discussed in the show does not imply any investment advice and is an opinion and not financial advice. Anyway, we've got over that. Hello and welcome to the show, Cole.
Thanks for having me. Glad to be here.
I was reading about Warren Buffett, who is also into books, and I read somewhere that when he goes into the office, he spends 80% of his time reading books.
He does, and that's what you'd really prefer to do. Just to give you a sense, I mean, Buffett falls in line with our own ethos on this, but I probably credit Charlie Munger more for affecting me personally and affecting how we think about our learning as investors. Because frankly, Charlie talked a lot more about his learning. He called it using multiple mental models, and the idea was that you are building out a framework or a lattice work, as some refer to it, of looking at the world. And, in Munger's case, he would talk, he waxed poetically on everything from physics to math, to history. And I think the one thing that can be said is history is, you have to, when you learn and study history, it's a very wide aperture. You're learning a lot about what's going on in history. And that aperture ends up being a fairly, what's referred to as liberal arts thinking here in the US, but the idea being it's multidisciplinary. And I think that's what's really guided a lot of great investors like Charlie and Warren over time. And I think the other principle that applies is, all of learning is actually just pattern recognition, right? You are recognizing a pattern. That's why we always say, you didn't find anything, you discovered it, right? You discovered the pattern that was at play. And in a lot of cases, that is what investing is. You're trying to recognize a pattern in a business before others, can recognize that in the public stock market. And that is very similar to the idea of discovery and learning.
Before we talk about your career and your path into investment, could you just tell us a little bit about your life's journey and how you eventually got into investment, please?
Yeah, it's a good question. I kind of have a cheat sheet compared to most people in that, my dad was in the investment business, beginning in 1980. So I'm just thinking, you're born in 1983. You are a kid growing up in the suburbs of Seattle in the Pacific Northwest of the United States. And, you come from I'll call it an upper income family, and you're like the 7-year-old that knows what a stock does and what the brokerage business is and what the stock market is. And so I'll never forget when I was in first grade, I had a teacher, her name was Mrs. Pillman. And so it was like, your dad could come in and explain what he does for a living. And nobody in my class was going to guess, that my dad was a stockbroker, because they'd all try to guess what he did for a living. So there is, I think, in a suit that day. And it's like, I'm just dying to tell them that, yeah, he's a stockbroker. At that time, it would have been, I'm trying to think here, at that time, it would have been probably Oppenheimer that he was at then. And I just was elated with that idea. And in many cases like that's, that continued with me. I really looked at my life as a younger adolescent to be one of three opportunities. One, go in the investment business. Two, I grew up in the era of Top Gun being a very cool movie, and it still is, in my opinion. But the other question was, maybe I'll go be a naval aviator. And I looked at, when I was a senior in college, I actually talked to a recruiting officer and talked about going to officers candidate school potentially in Quantico, Virginia, which is where where that goes on in the United States. So that was still a path that I thought about, even as a 22-year-old young man. And then the other thing was playing Major League Baseball. I've always grown up a big fan of baseball. That path, dimmed as I got, past high school. And therefore it was really, do I want to go in the investment business or do I go, fly Navy jets? And it ended up being that I obviously went in the investment business. My first job out of college was with what's now Wells Fargo Advisors. But I remember meeting one of the Blue Angels, which is, one of the highest performing naval aviating groups in America. They do a lot of shows around the country. And I ran into him in Seattle at a thing called Seafair, which is like it's their fleet week, right? Where the whole fleet comes into town. It's a lot of fun stuff, has a historic importance. And I asked him, about, how did he end up as a Blue Angel? And then I got to hear the commanding naval officer speak at my dad's Rotary that week. And I remember telling myself at the time, I said, well, gosh, those guys are really impressive. I better have made the right decision to go in the investment business because otherwise I've made a bad mistake. And, sure enough, I'm in the investment business. It's been a blessing and consider it, my life's calling.
Smead is a fund management company. Could you just explain what the role of a fund management company is?
Yeah. Well, how about I'll explain to what it's typically, what typically is done in the fund manager role. And then I might explain a little bit how we look at this differently for our own personal lives and thus our involvement with the fund management world. So to your point, I'll use the UK context. They're very commonly in the UK, people use unit trust or OICs or occasionally Irish or Luxembourg UCITS funds to invest. Okay, here in the United States, they use what they refer to as 40 Act mutual funds, which are very similar, commingled investment fund structures where a bunch of investors at different sizes and different shapes and different means come together to invest together with a professional portfolio management team. And that's really what we are. We are a professional portfolio management team. We not only, in our case, we not only manage the underlying investments, we pick the investments for our investors, but also we do everything from, the reconciliation of the portfolio assets. So you're doing all the operations involved in that. Outside providers typically do things like the transfer agent services. So if you interact with, you want to purchase that comes through the transfer agent. That's usually done by a third party. Most people hold these investments at their banks or brokers. And again, that's a whole nother service. So that's who's servicing the customer on a more direct basis would be the banks, brokers, and the transfer agents. And all we do is communicate, share with them what we're doing on our portfolio, and we buy and sell securities that's in their best interest is what they refer to as a fiduciary. Okay. Now, what makes us a little bit different is I work with my dad. He's our chief investment officer. That's a little bit different. That is, it's like nepotism run amok is how I think about it. But I think the other part that's a little different of us, beyond having our name on the door, which I think is an important part of personal pride, is that we also choose to invest, all of our capital side by side with our investors, which you'll find more often than not is less common. So for example, kind of laying my life bare, I do not take financial advice from someone else. All my liquid net worth sits in, our equity strategies that we do for our investors. And we think about that as from the perspective of alignment and focus. In other words, is my own mind going to be more focused on the outcomes of our investors if I have investments elsewhere? And the answer is, well, by definition, I wouldn't be, because, where your money is where your heart is. And so we've chosen a very different path to be very aligned with our investors in that regard. Not all people do that. Again, it's the only way we feel we can ethically go about this and try to get the outcomes that we would be aligned with these folks. But I just say that because in our industry, there's a lot of people that manage money. There's a lot of people that service those investors. You'll typically find that I've historically seen there's not a lot of alignment in terms of what they do and what they'll do for the customers. Even though I love our industry and I love like I said earlier, I love the stock market. I tend to look at some of the ethical standards of our industry be a lot lower than I'd like to hope for. Again, we don't have to do that. But my point is just that our alignment is something that keeps our interest and our alignment with the investors to be at a level that we think is appropriate for our industry.
Your own personal wealth, you would invest in similar funds.
Correct. Well, that's all we own. Yeah. So to your point, some call it eating your own cooking. That's my personal favorite. Or the other thing I'll hear in the UK is like we're on the same journey.
Yeah.
We're riding the same ride as the investors. And so if we do good, we share in those rewards. If we do poorly, we also, bear the brunt of that too. And so, we understand what it's like to be the investor alongside them.
with pensions, I don't know if it's the same in the States, but most pensions were able to get a lump sum tax free. You can put it in property, you can put it in an active fund like yours, you can put it in a passive fund.
Sure.
You could buy gold or silver. What should people be looking out for, do you think?
Well, if I had to kind of give, and I'll use the UK because I go there often enough that I know enough, I guess is how I put it. Let's just start with the picture of most humans. How do most humans deal with investing just in general? Okay, to your point, the stock market has volatility. Prices move up and down every single day. There is a subset of people out there that just will never deal with that well, whether that be investing directly themselves, whether that be owning funds and picking those funds, or even working with a financial advisor. They might just, there's times where you're going to have bear markets in stocks and watching stocks decline 20% is just not enjoyable for them. Okay. We do not believe the stock market was created to make everyone rich. That's not the point of stock markets. And I think that has been confused and conflated and perversely been explained to everyone that no, through behavioral finance, we can just make sure that we match your needs and all this stuff, and it's going to work out fine and dandy in the stock market. We don't believe in that because we just know through human experience that the humans in aggregate buy at tops and they sell at bottoms. And the problem with that is they take what would be a good long-term return in stock market history, thinking like global stock markets, US stock market, et cetera, and they take those returns and make them worse by being human, in effect. And so I say that because that's what we refer to as it's like recency bias, where you're like, well, how's the stock market been doing recent? If it hasn't been doing well, you get out of it. If it's going up recently, you buy it, and that kind of creates that problem. But if I had to give a picture of what I've seen in the UK, I'm just going to kind of cut to an idea that we've talked a lot about. So in the UK, obviously, the London Stock Exchange, relative to, say, the US stock market, has not done well. Okay, looking back 5-10 years, I think European markets in general right now are running into a 25-year high. They're back to a 25-year high. And so those markets have not done well. And so a lot of people in the UK that do choose to invest in the stock market have chosen to invest a lot or most of their capital in the US stock market. Now, I say that because think of what I said about recency, okay? Why are they doing that? Well, because it's done well. Now, the question is that how they should be investing in common stocks? I think that's a whole nother question. We see this outward bias for people to outright own US stocks, and let's just use the S&P 500, the passive investment is what their bias is to do that. And people often forget that when you buy that passive investment, you're still buying an underlying portfolio of companies. It just so happens today that it sits a lot of that in 5 to 7 companies. And the question they should be asking is that what I should be doing with my capital? Most of them are not. They're just saying, how do I get a return that I think would be meaningful, to your point, to my retirement or the needs I'm gonna meet? But again, the analysis of whether that'll meet that is completely separate from the returns you might get year to year, day to day, week to week. And so I think the idea of American exceptionalism in the common stock market is creating this like one decision idea. You'll even see this more common in the UK market is you'll have global managers there where they'll just kind of own a global equity portfolio. And if you look at most of those global equity managers, they are sitting there owning a lot of US stocks. They're not really global. They're really US equity managers with a few international companies mixed in. And again, the question is, will that produce the outcome that people want? That's what the future answers. Just because everyone's doing something doesn't mean it's right. And I will actually, from a UK context, let me throw out something that your readers could go down a rabbit hole on. I think this is wonderful. John Maynard Keynes, who we have Keynesian economics from, and it is well known in, call it, economic circles. Most people forget that Keynes picked stocks. In fact, he did that for what was called the chess fund, and he picked stocks at a time that the typical endowment model at a university did not own a lot of stocks. It was typically property back then. The bias was to own property and collect rent on property. And Keynes really led what I would consider as the early realm of concentrated stock picking, which is something we do. We only own 25 to 30 companies. Keynes had what he called his pets. It was the idea that he had these very few stocks that he liked. And I point all that out because if you look at his returns, they were very good. And one of the ideas that is never, I mean, Keynes has always kind of trapped me in this idea, and I love this idea. He said, investing is the only sphere of life where victory, security, and success goes to the minority and never to the majority. So while we talk about this idea of like, what would most people want to be doing in investing, you have to do scarce behaviors to create wealth over time, because if it's easy, how can it be profitable? Is one of the big ideas that people should take. So, and that's vastly different than if saying, I want to buy a 10-year gilt. What does it yield right now? Well, you know, you're going to make the 10-year gilt yield. The question is, other things you'd ask would be, hey, what's the inflation I have to deal with? Will that meet my needs net of inflation? Things like that. But in stocks, I would say, you know, the different calculus is it's an unknown future, and the price you pay for that could have a very detrimental effect or a very positive effect on your future outcomes. And I tend to see that minority type of opportunities where you're doing something out of consensus, to Keynes' point, has produced outsized success. I mean, use Buffett, like we talked about earlier. How many people were going to the Berkshire Hathaway meeting in 1980 or 1985 or even 1990? Now it's a circus show. It's Woodstock for capitalists. And you're going to find out what he thinks about, you know, his advice to children. But do we find out a lot about what he thinks about investments? There's a lot less of that today. And therefore, you know, the things you could learn the most from Warren and Charlie were at the meetings where no one was there.
What are your thoughts about gold and silver? Because of the fact that it seems to be becoming scarcer, and you've got Russia and China buying an awful lot of gold and silver at the moment.
Yeah. So here's a way to think about any commodity business, particularly. Predicting demand is very tough. So to your point, someone says, hey, you know, the Sultan of Brunei is out buying gold and he's wicked smart. We should buy gold. I'd say, well, you know, that doesn't really teach me much. Who's buying today or where the demand's coming from? It doesn't teach you much. In the gold market, the main use of gold in the long run is jewelry, just so we're all on the same page. So if someone says, hey, what's good for the gold market? People getting married because it's a natural use of jewelry. And I'll use my own spouse. I buy my wife more jewelry than I buy myself. And so therefore she is a better way to, you know, give me an indication of where gold demand would go in the jewelry market. Now, that being said, we don't take a lot of credence to predicting demand because it is so tough to do that. In many ways, the jewelry market's been kind of backwards for a while because obviously if you look at marriages across the Western world, marriages have been subdued compared to the past. And so the natural jewelry demand hasn't been as prevalent. That being said, has gold been a pretty good predictor over hundreds of years of the cost of inflation? Yes, it's been a better protector of inflation relative to paper currencies. So I think if you go back and look at like the Roman centurion, during the turn of the millennia, when Christ was born, you'll find that gold has done a pretty good job of predicting future inflationary demands and maintaining its value. Now, why should be the question. And the answer is, as Sir Isaac Newton learned, you can't assay gold. So therefore, the cost of gold in the long run is highly tied to the cost of extracting it out of the earth. And as we took out easier veins of gold, you have to go to other places to find those veins of gold, and the cost of extraction goes up. And hence, because cost of extraction goes up, it's done a good job of protecting from inflation because of the cost to extract. That cost to extract idea is not new. A lot of people will use that in the commodity markets. Historically speaking, most commodities bottom at the aggregate cost to extract. Okay, now I think a lot more about supply. So think about a gold mine. Is it easy to go out and create a new gold mine? And the answer is no. There's a lot of capital that's needed. There's a lot of approval and regulatory needs that are needed for that. Gold also benefits from something else, which is that in times of fear, gold tends to run up because people use it as kind of a safety proxy. Okay, so use like 2020 as an example. Gold went up as people got scared. Okay, so I think you have to, in gold's case, you have to look and say, okay, is there a fear scare that's causing people to price this up? Or maybe it is the fact that supply is tight and demand continues to grow, and therefore those are just positive economics for gold. I am with Keynes in that I think it's a barbaric relic. Okay, for long-term wealth creation, it has not been a good way to do it. Though, like I pointed out earlier, some people are not made to own stocks. So there could be a subset of investors where that makes sense for them. And you know what? God bless them. I wish them well. That's just not how we've seen ways to create great pools of wealth over time with whatever means of capital people bring to the table, whether that's 10,000 pounds, that's 100,000 pounds, or it's 100 million pounds. Common stocks have been a better way to produce good outcomes in the future for whatever those are for the investors. We use a lot of that supply theory at studying a lot of things, though. For example, let's use housing. Okay, the UK housing's done well. Okay, now why? Well, supply is fairly tight in UK housing. Land is tough to come by because there is still what I will call gentry land. Okay, right? Wealthy people owning large tracts of land in the UK. And that still limits the supply of housing because land is a dominant feature of housing. A little read through, we used to own some of the UK home builders. And so therefore we know a lot about the economics of the UK home building business. The biggest difference of thinking about the UK home building business versus say the US home building business, just for your listeners to hear, is that our mortgage products in the United States are long-term fixed rate products. In the UK, they are not long-term fixed rate, they are floating, which can cause a lot more perversion when short-term interest rates go higher because it causes mortgages to get a lot more expensive. Yeah. Okay. Why that's a problem is because you're taking a long-term asset, I'll call it land and a home, and putting it on short-term liabilities, which those kind of things never work out well. Okay. And so I put that because that means the borrower's taking a lot more near-term risk versus in our market, when you fix the land, which is longer, and the home, which is longer, with a long-term fixed rate product, you're matching the liability and the asset together. So when I think about land, the scarcity of land and the scarcity of available homes for sale is one way of studying what could go on in a market. So we have the same thing going on here in the United States. We have tight supply of homes. So I always joke with people, do higher interest rates cause more homes to be built? And the answer is naturally no, it doesn't. It actually causes builders to say, you know what, in the interim, the buyers are probably not going to want to buy because ultimately the interest rates have gone higher. So that demand might be more tepid. So the home builders, just like they have at times in the UK, they will step back from building as much as they were going to, and they will delay new builds because the mortgage cost has caused the demand to curtail in the interim. I think supply is just the most important thing to study in a lot of industries. Look what's going on in the North Sea, for example. No new supply is coming into the oil business, the North Sea. In fact, supply is shutting down. That is what's going on in the oil business in a lot of places. Either supply is shut or it's not growing at the rate it used to. In our country, we've grown a lot of barrels the last decade or 20 years, but now growth is curtailing and might even flatline. And so we tend to like industries that have supply that's very tight because it doesn't mean you can predict demand, but it does tell you that if demand is bigger than people expect, you tend to get pretty good pricing power in the business you're in. If I had to use some other examples that, think of banking in the UK. There used to be like challenger banks, like a Metro or a Virgin that came into that space, and it was like, oh, they're going to be challenger banks. They're going to get after these big banks. Well, actually, what's happened is the environment has shaped to where regulation is very high, and so the fact that that's all that came into the market limited the future competition. And if anything, today those challenger banks have not succeeded. And so what does it tell us about the supply of new banks? It's going to be very tough to get investors excited about adding a new bank into the UK, which means the growth of the economy in the UK is going to be dominated by the existing banking franchises making money because supply is not growing. Okay. And so again, you can apply what they call the capital cycle theory is what that's referred to when you study supply like that. You can apply the idea of the capital cycle theory to a lot of industries and a lot of places. And that's something we tend to look at a lot when we try to analyze businesses and ask, what's going on in the industry? Is there new competition coming in, thus supply is growing, or is supply actually dropping and therefore there won't be new competition for maybe a long time?
How do you see the US and the world economy under Trump with the tariffs that he's introduced to China, Canada, and Mexico, for example?
Yeah.
There was a bit of a falter in the stocks yesterday, wasn't there?
Yeah. I'm going to give you a very different take on this. And I apologize because, again, I would just say up front, this is a theory. It's not a law or a rule, but it's a theory. Charlie Munger talked often about invert, always invert. Okay. So most people are looking at this from the perspective of, okay, what will these tariffs do for the United States? I don't think that's how people should think about it. They should invert it and say, what will these tariffs do for Canada? Or what will they do for the EU? Okay. Ultimately, I would say if you read between the lines, the Trump administration is not saying, hey, we want to stifle competitive entrance into the United States. That's not what they're saying. All they're saying is we want to have the same playing field as other people in their own markets that we give in our own country. So, for example, if you look at the tax that we charge German cars, it's much lower than the tax that Germany charges American cars to go into Germany. Now, why? A lot of this came out of post-World War II industrial policy, where Europe was destroyed, frankly, and Japan was destroyed too. And so we said, okay, let's use some protective measures to allow their industries to build up and get really their feet back under them. And at some other time, we might not need these. Well, what we did, we just never went back and asked, what has changed, and therefore, how should these policies change? Okay. So here's the weird inversion I'll give you. I actually think that this, what seems like harmful rhetoric on its face, is actually better for Europe and it's better for Canada than it will be in the United States. Because again, back to my prior point, do we tariff their goods coming in here marginally compared to how they tariff our goods going out? The answer is no. So we can't save a lot of money in this discussion as American consumers. But if trade barriers and tariffs come down for products going into those countries, it will create consumer savings that no one is trying to think about or dream about in those economies. And so I think a lot about what that will do is that will cause lower pricing in goods to the consumers in those respective countries. And those lower prices will cause larger consumer savings, a la more money in the hands of people that can spend it. Okay. And I don't hear people saying that. It's so matter of fact in my mind, because I think they're just assuming that these will stay in place forever. And this is just purely, there's barriers to trade. No, these are not barriers to trade. These are, hey, let's have equal and level rules. And again, I'll use Canada. Canada, it's very well known that they do not like a lot of competition in their dairy market, for example. And there's something in Canada called milk money, where they literally give children milk money to subsidize the agricultural, the dairy business. Okay. That is just a form of subsidy. And if you tariff goods coming in, that means you don't introduce new competition. I think we're going to see a lot level playing field, because David Ricardo was right when he talked about the law of comparative advantage. If you take three countries, they each specialize in one thing, you're going to get more total trade. I think the one other lens you have to look at all that through is that would be assuming also that you don't have any security issues among those countries, which, use the Europe and the United States. If we don't have any security issues, David Ricardo's law falls in line. What do you see being announced in Germany today? That they need to greatly increase their defense spending. So I think as you see a lot more similarities in tariff policy and defense spending, for example, you're going to see these tariffs are not even going to be a discussion, just getting to that level playing field. But again, that won't help the United States. That will help these foreign consumers a lot more.
That's very interesting. I take it from that your assumption is that after yesterday's blip on stocks, that the tariffs over the medium term won't really have any effect on the performance of stocks?
Well, let's put it this way. It's scaring people out of industries that could be affected by it. So, I mean, let me just use an example in Europe. If you go out and look at the German car businesses, I mean, those are closer to their most recent lows, not their all-time highs. And so you can see that the market, to a certain extent, had been starting to price, the worst case scenarios in potentially. If you ask me, Cole, what's the outcome on all this? I mean, I think anybody that says here's the outcome, I don't think they're paying attention enough, because I think that's very hard to understand. But I do think that the markets are moving faster than the rhetoric is. And if you look at a lot of the discussion, all they have to do is say it, and markets are scared, because markets are highly elastic, but a lot of these underlying businesses are fairly inelastic. So again, if Trump's going to tariff Canadian oil, well, it takes a long time to change Canadian oil production up or down. And so the market doesn't adjust very quickly to that. But if you just say it, stock markets move immediately off that. And I think the difference between some of these underlying markets being inelastic versus the stock market being highly elastic, that's where you're seeing these real big dispersions day to day right now.
I'd like to talk about crypto, particularly the fact that President Trump has announced a new strategic reserve for cryptocurrency.
Yeah.
What are your thoughts on that?
Oh, I'm 41 years old, and most people probably assume that I'm like a great person to talk to because I'm just young enough that I would care about these subjects. And again, I fall in the Charlie Munger camp of I think these look more like rat poison or reasons to gamble for degenerate young men, frankly. Because again, if I go out and I'll use my petri dish I have here in the United States and ask the question, okay, who do I tend to see participating in crypto? It tends to be someone less than 35 years old, particularly someone less than 30. And that's the same person that does a lot of sports gambling. And my only problem with that is that's the same people that have been doing a lot more high risk reward relationships in things like 0-day options in the stock market too. And what I see is the ability to gamble day to day, not the ability to ascertain that something greater going on. So, I mean, let me just give you some framework around crypto. Okay. I mentioned gold as a barbaric relic. Okay. The worst part about gold is it doesn't pay you a dividend. It pays you no interest. You sit on it. The old joke is that if the Martians look down on us, they say we take something out of the ground, we refine it down, we put it into gold bars, we then hand it to someone else and they put it back in the ground and they watch it for us. Okay. And the old joke was the Martians would scratch their head. Well, take that. And in the case of gold, I would say, there is a history, like I said earlier, of it protecting from inflation. And that's true. In the case of crypto, people have seen it go up a lot in value. The difference is the supply of gold grows over time. If I'm just using Bitcoin, the supply of Bitcoin is fixed. It's permanently fixed. It can only get to a certain supply. And so I say that because if I'm giving you a framework to think of all of economic theory, the Chicago School monetarists would argue that the supply of money has to grow with the rate of the economy's economic growth, right? That makes sense because if you have a business that's doing great and it grows, well, there should be enough money for the economic growth that's coming off that to be in the real economy. Otherwise, you get into a deflationary battle where it's like if someone else has a lot of the money, your business is doing something great, they might want to sit on the money and stifle the economic activity. Okay. And the propensity over time is for most governments to overprint, as we all know, in times like wars, et cetera. But I point all that out because you still have to have the money supply grow with the economy. You can go find new gold. You can't find new Bitcoin. And again, if I look at the activity underlying users on a lot of this, there's just a lot of risk taking and gambling going on by age, by choice. And so again, I'm learning to learn. That doesn't mean I'm right. Okay. But so far, I haven't seen a fungibility in that form of money that supersedes what we have. I would jokingly say, do we really need to create a new way of a currency? I think we did a pretty good job of losing money in the old ways after inflation anyway. Why do we need a new one? And I think that's what I've come to the conclusion of so far is the old ways of losing money work just fine. Why do we have to find new ones?
The next question I've got is I'm not asking you to divulge any of the details of your funds because obviously this is a pretty generic conversation. But would there be any fund management companies that would have investments in crypto at all?
That's a great question. In the UK context, I would say, I there might be, but there's probably not a lot out there. And I'll use, we have a Luxembourg UCITS vehicle is how most UK investors access, our portfolio. You're going to deal with a lot of the illiquidity issues and whatnot. So the question would be the regulations around that. Here in the United States, you'll see ETFs that are using, Bitcoin as a way to go out and transact. And again, just because regulators allow for something doesn't mean it's blessed or inherently going to do great. Because there's a lot of things over time that might get a blessing from a regulator, but yet people can lose a lot of money on. I mean, go look at SPACs just as an example. the special purpose acquisition companies that became a primary way for people to raise money in IPOs in 2020 and 2021. Those vehicles, while being a newer way to IPO companies, didn't produce good outcomes for investors. And so I would always point that out, is just because regulation allows for it doesn't mean it ends up being a great way to make money. I'm more skeptical when Wall Street is selling something. The old saying is that when Wall Street is selling you something, it's because they have an incentive to sell it. You just don't have an incentive to own it. Okay. And I think that's the flip side of this is you should always be skeptical of what people are selling, especially when a lot of people are selling it. And that's my criticism of it. Again, some could argue I am Orwell's Luddite, but I think the only problem with that is the Luddites, aka the farmers, ended up becoming very wealthy, people because they used tractors to ultimately make their money, and it worked out pretty well for them too in that subject.
We have a group of listeners who we have sort of like a little dialogue, and one of the, I mentioned that you were coming on the show, and one of my listeners asked me if I'd ask you this question,
okay,
which is, some companies the dividends come on a monthly basis, and others are quarterly. And others are sporadic or perhaps annual. What are the advantages and disadvantages of each of those payments?
Yeah, well, I mean, that's tied to the payment timing. Okay, I'm going to give you a little bit different framework to think about dividends, though, because this is something we think a lot more about. Let's say the executive of a business came to us and said, "Hey, give us, what you'd recommend for our, dividend or capital return policies." Okay, because that's a dividend is just a capital return. Okay, so I always point out to people, when a dividend is announced by a company, once announced, it becomes a liability to the company, right? Because you've said, "Hey, I'm going to announce this, and there's going to be an X dividend date," and then once that X dividend date comes, it's due to the shareholders. So it's technically a liability until it's paid. Now, once it's paid, it's no longer a liability. But from there, if you collect dividends in the UK, you're going to pay a tax on those dividends. Okay. So what's the issue with that? Well, I mean, in this country, we pay, wealthy people pay about a quarter of their dividends to the federal government for taxation purposes. And so I jokingly always tell people, governments are in the dividend business. Okay. They are. I mean, if a company announces a dividend, if I'm the federal government, I'm just, yay, that's we didn't do anything. We're not taking any capital risk, but we get paid. And I'm not saying they're not, entitled to that. That's the law. But I just pointed out because that is what they collect and benefit from. They want dividends. Now, if a company instead says, okay, you know what, we would have normally paid a dividend, but we think our stock is so cheap that we're not going to pay that dividend anymore. So let's say they cut their dividend and they say, we're going to buy back stock because we know some of our investors might need to liquidate some of their stock to get their current income needs met. And we would gladly buy their shares back from them. That way there's liquidity in the market to do that. Well, when they do that, so let's say I'm a pensioner, for example, and I need 5,000 quid of income per month. Okay. And let's just theorize I own, I don't know, let's say I owned £500,000 of the stock. And so I got this 5,000 pound a month need, and I figure out they cut the dividend. So I go to them and say, okay, I go to my broker and say, okay, here's what we want to do instead. I saw they announce a buyback, so let's just do this. Let's just sell 5,000 pounds of stock a month, and that's the way I'll get my income. Okay. Well, I point that out because if you think about how the government collects tax on that, if it's in a taxable account, I would have to pay capital gains, obviously. But if it's in a tax, benefited account, where let's just say I don't pay anything on the gain, well, frankly, what tax was paid is de minimis, because I knew I'd get taxed if I get the dividend, versus in the case of the buyback, I got to go pay my capital gains back, to the government. But the rest of the shareholders, they paid nothing on that capital return. And so I always point that out because we're trying to think about, as investors, what are the after-tax effects of wealth? And we think about that broadly. So if someone owns a U.S. security that's living in the UK, they pay 30% of the income that they receive, whether that be interest, dividends, et cetera, to the United States government. So, again, even in that case, the government of the United States is in the U.S. sourced income business for a foreign holder. Versus if that same investor owning U.S. stocks, the company returns that capital to shareholders by buying back, certain shareholders, that foreign owner pays none of those taxes from that capital return. So I think you want to think often about the efficiency of returning capital to shareholders. When would a dividend be appropriate? Let's say the stock's way too expensive. Well, that's when a dividend would be appropriate because it doesn't make any sense to buy back stock. But I just pointed out because, again, I think you have to think about the taxation of the investor to really, apply that theory. To your point, in the long run, most pensioners or retirees would be more benefited to not seek out income, but to say, I'll just sell portions of my equity portfolio when I need to, and just accumulate their gains and just, clip coupons by selling stock. That's what history would argue. But again, that's for each person to decide. I'm just arguing from a pure return historical context. I will say this, in the UK, it has been more dividend oriented or income oriented historically. But if you look what's going on in the UK market, you're seeing pretty interesting things go on as companies are buying back stock. So full disclosure, we own Barclays. Barclays is buying back stock at a prevalent rate today. And what you'll see is that capital allocation is causing the economics of the business to get more valuable. And like we said, the government is collecting less of that capital return compared to the dividend they pay. So even intra-company, you'll see two different things going on. One, the government gets a piece of, and one, they get nothing of.
Yeah. Your familiarity with the UK is very interesting. And I noticed that quite prevalent on your website is the fact that one of the first questions that you ask readers when they go on is this a US investment or from overseas? What proportion of Smead's business clients are, what sort of percentage are sort of overseas and what percentage are American?
Yeah, it's a great question. So I'm trying to think of the number of, I'd say about 15 to 16% of our investors is non-US investors. So to your point, I mean, we effectively run two portfolios for investors. We run what we call a U.S. equity portfolio, which owns U.S. equities, and then what we call international. We're so arrogant and piggish in America, everything outside the United States we just put into this big international bucket. But again, or I'll call that an ex-U.S. strategy is a better way of probably thinking about that. That's all we do for our investors. And so, most of our investors use our U.S. equity portfolio because it's our longer track record. It's call it our flagship that we've been doing for many, many moons. But again, we look at this as, if an investor anywhere in the world sees a need in how we invest and manage money, we would love to figure out the best way to, work and invest side by side with them like we do with investors here in the United States. And, it's very odd to find someone in Phoenix, Arizona doing that. You don't tend to find firms in the West Coast that tend to have an office per se in the UK or a fund in Luxembourg. That's more of an oddity. But again, here we are having this discussion. It's evening in your world. It's, more so in the morning in my world. And in the English-speaking world, this is a global marketplace for ideas and thinking and learning and intellect. And so, it should not be shocking to anybody that the earth is flat because ultimately ideas will travel around the world and therefore intellectual capital and investment ideas will too.
Yeah. Tell us about, I mean, you've got the logo behind you, a book with legs. Tell us about the podcast and how it came about, Cole.
Yeah, it's a kind of a funny story. So I was actually getting on a plane to come to Europe, and I was going to the UK at the time. And I don't want to divulge too much of my secret, but let's put it this way: I had a friend, an acquaintance who was on a podcast, and the podcast they were talking about investment books on the podcast, and it's like the light bulb flashed in my head, and I said, "Well, that's a great idea. The problem is that's too boring because investment books are boring because again, you can learn reading a bunch of investment books is like being an academic. You know a lot about very little, and that doesn't help you in investing. Okay. And so the flash that went off in my head was, no, this is a liberal arts education. We want to learn a little about a lot. And so I called up who was still our PR firm at the time. And I said, hey, I got an idea. We're going to do a myriad of different subjects in the podcast. We're going to interview 2 authors every month, but here's why. Munger talked a lot about incentive structures, setting up the right incentive structures to produce good outcomes and behaviors in your life. And so the incentive structure was this. If we go out and interview 2 authors every month, we're forcing ourselves to read, which is what we should be doing all the time in our work. And so the incentive structure is we're holding ourselves to a standard to continue to learn ad infinitum in our careers, because ultimately by hosting the podcast, you got to read at least $2 a month.
Yeah.
And so that was the big idea. We're like 3 years into that idea. And it's been very fun. But that being said, I'm actually we're about to do a book on Geoffrey Chaucer, who obviously wrote the Canterbury Tales. And, if someone says, have you done a lot of literary histories like that? The answer is no. You mentioned Adrian on his awesome book about, country estates in the English countryside in the, 18th and 19th century. Never had done a book on that before, but we do think a lot about analogous situations. We're watching people post-pandemic go out and have all kinds of second homes and third homes, and the wealthy are just doing things that are just extravagant in those kind of places. And I thought a lot about Adrian's book as an analogous paradigm to think about what's going on today. Just like those families did not sustain their wealth, the question is, will the same families doing that today sustain their wealth? History argues no, based on Adrian's book. And those are the right paradigms to think about, I think, to think about what's going on now and how much of this is just a gestalt. It's a psychological feeling at the moment that doesn't actually end up being practical and pragmatic over time.
Yeah, no, I can, I got that. I had a light bulb moment when I was listening to Adrian on your show, and I thought, yeah, this social history that Adrian's talking about, it's full of economics.
Correct.
And that can only be good to enrich your mind, particularly if you're in the role of investment. And I found that interesting. But yeah, the Chaucer one would be very interesting, because you're quite right. Investment books themselves and money books, it's an acquired taste, isn't it? Let's be honest.
Well, but it's an acquired taste. But again, like I'm not saying you can't learn something from them.
No.
But you're trying to test theories and multiple models, because ultimately stock markets are complex adaptive systems. And so if you're going to go out and be adaptive, you need to be an adaptive learner just by definition. And therefore, I tend to see where people are very focused, but you need an aperture that teaches you analogous learning. Because again, you recognize a pattern in another field, and you turn and say, well, that's the same pattern I'm seeing in what I'm working on now, or looking at this industry or whatever. It could be in multiple ways of looking at this. But again, that's pattern recognition, and that's what you're doing in investing too.
And did you find that, obviously yourself, you had the initiative to start the podcast. Have you found that the rest of your colleagues and your dad are equally as enthusiastic about it?
Yeah, well, I mean, I'll use our investment team. We all do a lot of reading. It's pretty common that people will walk in and say, hey, I got a great book. You should check it out. We read a lot of books. The tougher part is not finding good books at times. It's making sure you get authors booked and set and all that kind of stuff. And then you got to sit down and write a script and what questions I want to ask them, and where do I want to take the listeners and the audience through, and what were big ideas in my mind. That's the part that actually requires a lot of work. I will say this, I'm a better student as an investor than I was as a student, because if you looked at the books I have all these notes in there and questions. And I mean, you think that it's like I'm going to the nth degree in my study of this book. And the reality is I am, because I'm trying to really understand what they're trying to communicate. And if you looked at my studying when I was in, say, university, you'd be a lot more disappointed. Now, there's a lot more profitable things I can do with the information, which is why I'm also a lot more passionate about the information.
If we've got any listeners, younger listeners perhaps, who fancy a career in the investment industry, what sort of advice would you give them? Yeah.
Well, how about this? How about I give them a couple of books? Because that's kind of my shtick, for lack of a better term. A book that kind of captured my imagination was a book by Joel Greenblatt called How to Be a Stock Market Genius. And he wrote it in the 1990s. And what his real argument, and this holds true today, his real argument is that the smaller investor has a big advantage on big investors. Okay. That paradigm holds true to today. I can prove that in a myriad of ways. But I think that book does a good job of capturing the imagination of how you can potentially, as a small investor, make outsized returns in the stock market if you are successful. Obviously, big asterisk on the if you are successful. But The other book uh, is Robert Hagstrom's book, Investing: The Last Liberal Art, which really gets to this idea of what we're talking about, is like this multiple mental model of learning, and why is this framework so helpful to go out and learn about history with this wide aperture, or one week going from Chaucer to another week, talking about crypto maybe in a book, right? Why such an agile thing? Because again, markets force you to be agile and they force you to learn. And I think that book does a really good job of that. I mean, I'll give you an example of where I've done some recent reading and I can apply this paradigm out. Really fun book. This came from actually Berkshire. Like you have listeners on your podcast that have given you some good ideas over the years. We had one, we refer to him as Superfan Steve. We like naming our fans. And so Superfan Steve came and said, hey, it's this book called The Caesar's Palace Coup, because Munger had mentioned it a few years ago. So we read the book and immediately light went off in my head. Oh my gosh. The property company and operating company model of casinos, which has also happened in the hotel business. Think of brands like Accor in Europe, is a model that is not new to capital markets. It just tends to show up new to industries. And so we are watching that model end up in home building in America today. And so here I am reading about a book and I can apply the model to ask, well, what were the outcomes of that? And again, that is a model I could directly apply because it was somewhere else in the investment business or somewhere else in business that you can think about that model. So I really think a lot about Hagstrom's book and the idea of liberal arts as a way to learn. But again, from an investing perspective, you have to be excited to go get great outcomes and create great outcomes in the stock market. So to your point, you got to have something that kind of tickles your interest in investing. Otherwise, you could just be an intellectual and you could say, I just like debating the finer points. And by the way, there's nothing wrong with that. That's a wonderful thing in my perspective. Not everyone wants to be a great investor. Not everybody wants to make a lot of money investing. They might just enjoy taking it easier, paying a wealth manager to do what they do and not really caring. I know that humans tend to be greedier and tend to want more. And so they all are tickled at some point, at some era in investing.
Yeah. Before I ask you where people can find out more about you and your company, what I'd like to ask you actually, as well as doing a lot of reading, what do you do outside of work, Cole?
It's funny. We've talked so much about reading and work. So the answer is I've been married for 16 years to my beautiful wife, Katie. I call her what is referred to as the GOAT here, the greatest of all time. I love her to death. Her and I have been friends long before we ever dated or got married. We have 4 kids, ages 15, 14, 10. Those are our 3 girls. And they have an 8-year-old son. We finally had the boy, if you will, against the odds. And so my kids, I love my kids. I love spending time with them. So we are currently in coming out of basketball season and going into baseball season here. And so a lot of our time is, dedicated to what they're doing, their day to day, their school life, things like that. Beyond that, I love skiing. And, that kind of tends to be my way to, do a lot of fun stuff. So for example, I've skied a handful of places in Europe. It's amazing. I wish I could do it more often, but again, to your point, there's a lot more interesting things we can do in our reading and our work. And therefore that's where most of my time is preoccupied.
And where can people find out more about what you do and your company?
Yeah. So our website is smeadcap.com, SMEAD. And you can also find out more about us on places like X or LinkedIn. Our handle on X is @SmeadCap. We tend to be, communicating out on X and LinkedIn as well. So you can find me on there. My handle on X is @Cole_Smead, I believe. And, the only downside to a Smead is we're going to have an opinion on something more than likely. So, take that with what you want from it. But we also write often. So on our website, you'll see we write what we call missives, where we go out and communicate to investors beyond the podcast, which is another way that obviously people access, what we're thinking about. We do quarterly book lists where my dad and we typically sit down and talk about the books we're reading, books we got done. We talk about some of the finer points we ascertained out of that. And so it tends to be a very fun experience of thinking about what we've accumulated knowledge. Never forget that when you read a book, someone spent hours of time accumulating that knowledge. Yeah. And you're paying 20 pounds, 30 pounds to get all that knowledge and information, it's a steal.
It is.
You're winning the game of life. And I think people always forget how much knowledge can be attained for such a cheap price. That is the vastness of our wealth, is the information we receive. And therefore, the information that's dispersed in society through books is really what the modern world benefits from in such a great way.
I don't know if you ever listen to audiobooks. I mean, I do sometimes, particularly if I've got a guest and I've run out of time. But I do. I think you can probably see behind me, I've got a few books. But I do get more out of a hard copy book.
I tend to be a hard copy person. I've also read books on. I use like the Nook app or the Kindle app occasionally on my phone when I can't carry a book with me because of travel or something like that. I have tried audiobooks. I've done them on kind of open road trips where I got the kids in the back and they got headphones on or something like that, and I want to learn. I think the only issue is it takes so long to read a book via audio. You can read quicker on the page. And since I like writing notes, I tend to be a hard book person, whether that be a paperback or hardback. And so to your point, I'm old school. I'm like the 41-year-old old school person. I'm kind of boring in that respect. I'm becoming an old man, way ahead of my time. And that, I think that's luckily, but some might say it's unluckily. The only other thing I didn't mention from a UK perspective is your listeners should really study up on Sir Isaac Newton. We all know him as this brilliant mind. And, when I was talking about gold earlier, he proved that you can't assay gold. And as people study things like the South Seas bubble, he has one of my favorite quotes. And obviously the South Seas bubble was government related, as we all know from history. But he says, I can understand the movement of celestial bodies, speaking of the stars. And he says, but I cannot understand the madness of men, or madness of crowds, I want to say. So here's one of the greatest minds of all time who participated in a euphoria and a mania in the UK stock market back then. And I only say that because never forget that intelligence does not equate to investment outcomes. And that tends to be lost on people.
Well, Cole, it's been a really great conversation. It's been interesting to learn more about the world of investment and the stock market and how your interest in books and learning contributes in part to your investment decisions. My guest today has been Cole Smead. Cole is CEO and portfolio manager of Smead Capital Management and a host of A Book with Legs podcast. And you can find a link to Cole's company and podcast in the show notes. Thank you for coming on the show, Cole.
Thank you so much.
You have been listening to Undercurrent Stories. I hope you enjoyed this episode. Please feel free to share the show link to your friends and family. And if you have 60 seconds, I will be most grateful if you would please rate and review. To hear more episodes, please subscribe to the show and visit undercurrentstories.com. If you leave your email in the link, we will notify you as soon as new episodes are released. Also, check out our social media links, details of which can be found on the show notes. Until next time, this is Bob Wells wishing you all the very best.